Hello friends, hope you all are doing fine. Actually, I have been receiving a few requests in the last few days uh, that I should make a video on how to study stocks and how to basically how they should learn the very basics of stock market and corporations. So I decided to make one. Uh, Obviously, the number of additional subscribers and number of views may not be much, but if I can help even a few people through this video, I would think it would be worth it for me. So, in fact, I was also looking through my subscribers data. I was shocked to see that only 10% of my subscribers are females. So, I do hope that in the future this gets changed and more women participate in the stock market because uh, in the last 2 to 3 years, after specifically after COVID, the number of demat accounts has exponentially increased. So I just hope in the future as well, more and more people participate because the participation rate is still very low, and this is even lower for women. So through this video, I hope I can just help even a few people, and obviously the people with the finance and accounting backgrounds can easily skip this video because I'm not going to talk about even a single stock in this video, single particular stock. So to begin with, we have to understand that there are three basic forms of business: sole proprietorship, partnership, and corporation. Sole proprietorship is basically nothing, a single person handling everything related to the business, and he's the owner and he's in full control of the business. Basically, a grocery shop would be an example, and in this case, there's no distinction between the business and the person. And in the case of partnership, basically two or more people join together to launch a business because one person may think that he or she may not have the appropriate amount of capital or the enough expertise to go through the business. So a partnership may be formed, and profits and losses and investments can be shared among the partners. So, but important thing to know in this two forms of business, sole proprietorship and partnership, is that first of all they have unlimited liabilities. That is, the personal assets can be used to pay back the creditors and lenders of the business. And second of all, they do not have to pay taxes on business income. Obviously, the income flows to the owners who then have to file their individual income taxes. So basically, there is no double taxation. The profits are not taxed at the business level. Now, the third and the most important form of business, specifically in our case, is corporation. Corporation is basically a separate legal entity of business where people join together, uh, specifically promoters, to launch a business, and it is registered with the registrar. And there are a lot of formalities that uh, that needs to be fulfilled in order to make a corporation bring into existence. So, the most important point to know in this case is that it is a separate legal entity. It is recognized in the form of, in the eyes of law, as a separate entity. So, there are two forms of corporation: private and public. Initially, it is the private corporation, but when the corporation starts getting bigger and it needs to grow and expand, it does not have enough capital, it may seek the help of public to raise funds. So, in that case, private corporation is very privately held, in the sense only a few shareholders might be having the stocks, and stocks or shares are not traded in the stock market. But when a private company wants to go public, it has to launch an IPO, which is called initial public offering. In this case, basically the shares are basically launched to the public for the first time in the stock market, and now people can actually buy stocks. For example, obviously we know about different IPOs, and for example, we have Adani Wilmar IPO right now. Now people can buy shares in exchange for a percent of ownership in the business. So basically, shareholders are nothing but a part owners of that business. So that is important to understand. Often we focus on share prices and shares, but we forget that we are buying a business. Stock is just a form of representation of that business. Now we need to know the features of corporation. Corporation, as I talked about, has a separate legal entity and it has limited liabilities. That means shareholders' personal assets cannot be used to pay back the lenders or creditors of the business. Their losses in the corporation are limited to the extent of their initial investment. That is the value of the shares they are holding. So that can go to zero. For example, in the case of DHFL, I lost all my 6.5 lakhs I speak about it quite a lot because I want people to understand that their investment can go to zero even in good companies if something goes wrong. So that is a risk. But obviously, my personal assets were not used. Lenders did not ask for my personal assets to obtain their funds from the company. And the ease of transfer of ownership. For example, in a public company, we can just sell our stock and we will be relieved of our ownership, and some other person who buys the stock will get the ownership. It is a separate entity. And other important point to remember is that there is divorce between ownership and management. Owners are different from management. Obviously, there are thousands and lakhs, thousands and millions of owners in big corporations, big public corporations. So all of them obviously cannot manage the company. So they elect the board of directors who are then responsible for running the daily operations. So basically there's the difference between uh, ownership and management in corporation. Owners, obviously all owners cannot go and undertake the management of the company. And now coming to stocks, they are important. One important golden rule is that assets is equal to liabilities and equity. Assets basically what a business owns, what resources a business owns. Liabilities basically the obligation that the business has to its creditors, and equity basically the obligations that it has to its shareholders. So it's what a business owns at any point in time is equal to the sum of liability is equal to what it owes to its creditors and what it owes to its shareholders. So we should understand debt and equity. Debt is basically forms of loans or obligations that a business undertakes. For example, a business may take a 30-year loan from a bank. In that case, it has to pay its periodic interest payments, and there's also a fixed amount that it needs to pay back after 30 years. Obviously, that is a long-term liability or a long-term debt, but there are other forms of debt as well. For example, there can be a loan in which we have to pay in annuity. Annuity means, for example, a specific amount for a fixed number of years. For example, if the business takes a loan of 1 crore, the bank may ask for 15 lakhs payment per year for 10 years. So, and again, the equity, as I talked about, it is basically the investment of shareholders. Equity can be divided into paid up capital and retained earnings in the broader sense. Paid up capital is basically what the investors have actually invested in the company through buying shares, and retained earnings basically is the sum of all the profits in the previous years that have been accumulated and that have not been paid back in the form of dividends to the shareholders. So that is equity. Equity consists of paid up capital and retained earnings. When we study the annual reports, or when we try to study any company, we come across three basic financial statements: income statement, balance sheet, and cash flow statement. Income statement is basically it reports the profits and losses. It has revenues, expenses, and profits and losses that a business has incurred during a given period. And balance sheet is shows the assets, liabilities, and equity at any point in time of a business. Cash flow statement shows the cash inflows and outflows of a business during a given period. So profit and loss or income statement is very important. For example, we'll need to look at sales. We can see how the extent to which sales are growing from year to year or from quarter to quarter. That is a very good signal to see if sales are growing. I personally prefer sales over net profits because if sales are growing, that means that the demand for products and services are increasing. Rise in expenses can be temporary, but if sales are not growing, that is a big problem for any company. Then there are operating profit and net profit. Operating profits are basically what is earned in the normal operations of the company, and net profit differs from operating profit. For example, after operating profit we have to deduct interest, expenses, taxes to obtain net profit. The ratios, we need to look at ratios because absolute numbers may not make much sense. So one important ratio to look into is liquidity. Liquidity basically measures the short-term ability of a business to pay back its liabilities, short-term liabilities. So one important ratio is current ratio. Current ratio is basically current assets divided by current liabilities. Current assets can be you can have cash, accounts receivable, basically which can be converted into cash in a very short period are current assets, and current liabilities which the business has to pay back in a very short period. Often we calculate this using a year. That means the liabilities that have to be paid back within a year. So obviously the current ratio varies from industry to industry, but generally it should be greater than 1. For example, there should be more current assets relative to current liabilities. Solvency basically represents the ability of a business to carry in the long term. It can also measure leverage. For example, debt to equity. Debt basically is long-term liabilities we can use. Long-term liabilities are obligations that the business has to pay back for the longer term. And total equity, as I talked about before. So usually the lower the debt equity ratio, the better it is for the business, because the lower the risk is. Now there's profitability. ROE is basically return on equity. Net profit divided by equity. So basically what the business is earning relative to the equity investment in the business. Return on assets basically means the net profits divided by total assets. What returns it is generating on the total assets invested in the company. Net profit margin is basically net profit divided by total sales. So basically what amount of sales is being converted into net profit. So higher the figures, that means higher the profitability, the better it is for the business. Obviously it does not make sense to use the absolute values or absolute ratios. These ratios can be compared across peers, across companies in the same industry or industry average to make much more sense. Now we have efficiency, how efficiency the business is handling its own assets. One important ratio is asset turnover, which is basically calculated by sales divided by total assets. So basically for $1 of total assets, what amount of sales the business is generating. So again, the higher the asset turnover, the higher the efficiency, the better it is for a business. And we do not need to calculate these ratios. These ratios can be easily obtained from different websites. For example, Morningstar or Ticker and other websites are there that can provide these ratios for companies. For smaller companies, you can calculate them. Now we look into the key financial aspects, key financial concepts. We often come across market cap. Market cap is basically what the current stock price is into number of shares outstanding. So basically it varies from day to day depending on the movement in the stock price. Numbers of shares outstanding is nothing but the number of shares that have been issued to the public minus the number of shares that have been bought back from the public. For example, treasury stock. TCS is buying back stock soon. So in that case, the number of shares outstanding will decline. Now EPS, earnings per share. Earnings per share is basically net profit divided by numbers of shares outstanding. Basically, what the amount of net profit is being generated for every share. Now PE, this is one very important ratio to check how valued and whether the stock is undervalued or overvalued. Basically, it is calculated by stock price divided by EPS. And obviously we can multiply the numerator and denominator by the number of shares outstanding. We get the numerator as market cap and denominator as EPS into number of shares outstanding is equal to net profit. So we can also calculate it as market cap by net profit. So generally the lower the PE, the better it is for a business, because the lower PE indicates undervalued business. The higher the PE, the riskier the business is. But as I talked about before, the higher growth companies, the companies with greater growth potential generally have higher PE, because the investors or experts believe that there's greater earnings potential in the future. So they place a premium on the stock price. Now the price by book ratio is basically stock price divided by book value per share. Book values per share basically is you can say that assets minus liabilities divided by number of shares outstanding, we get the book value per share. Or in simple sense, in broader sense, we can use it as a market cap divided by equity. So again, the lower the price, the book value, the better it is for a business. Generally, I believe it's not be more than 5 or 6. Obviously, it varies from industry to industry. Dividend yield is basically dividend divided by annual dividend or quarterly dividend divided by stock price, depending on what we are calculating, a quarterly dividend yield or yearly dividend yield. So that is for that is it for now. We'll meet in the next video. Hope you like the video, and please like and subscribe it if you do.